If you own a condo in Tampa Bay or you're in the market to buy one, there are some significant changes to condo financing rules that took effect this year, and most people haven't even heard about them. These changes are coming directly from Fannie Mae and Freddie Mac. They affect the reserve requirements, insurance standards, and the way that the lenders review condo projects before approving a loan. Don't worry though, it's not all bad news. There are some really meaningful changes that actually work in your favor if you own a condo. Before we get into the specifics, if you own a condo in Tampa Bay and you're curious what your condo is worth right now, I have a free valuation tool linked in the description below. No obligation, just a current snapshot of your current equity. And if you have questions after watching this video about buying, selling, or what any of this information means for your situation, my contact information will also be in the description. I work with buyers and sellers across the Tampa Bay area, and I'm happy to have that conversation. So let's talk about where these changes come from. On March 18th, 2026, Fannie Mae issued Lender Letter LL 2026-03. Freddie Mac released a corresponding bulletin the same day. Both were coordinated with the Federal Housing Finance Agency. That's a lot, I know. So quick background, if you're not familiar with those names, Fannie Mae and Freddie Mac are government-sponsored enterprises that back the majority of conventional mortgages in the United States. Most lenders sell loans to them, which means their standards effectively set the rules for how most home purchases get financed. When they update their requirements, lenders are going to have to follow. These updates revise the standards lenders must follow when financing condominiums and HOA projects nationally, not just on the Florida level. The driving concern is the pattern Fannie Mae identified as being underfunded reserves and that buildings fall into disrepair. When associations don't have adequate reserves, unit owners end up absorbing the costs, usually through unexpected special assessments and sometimes pretty significant ones. These rules are designed to reduce that risk. The honest reality is that in the short term, some owners are going to feel this. If your association needs to increase dues to meet new requirements, that is a true cost. But the long-term intent is to actually protect you. A well-funded association means fewer emergency assessments, better maintained buildings, and a property that's easier to finance, which in turn protects your resale value. These aren't punitive rules. They're a response to what happened in buildings where reserves ran dry. So let's talk about change number one. The reserve fund is being increased from 10% to 15%. Currently, associations seeking conventional loan eligibility generally need budgets allocating at least 10% towards annual capital reserves. This is going to cover long-term expenses like roofs, elevators, structural components. Effective January 4, 2027, that goes up to 15%. Many legal experts reviewing this change have already noted that many Florida associations are believed to be below that 10% threshold. And that effect is that a lot of associations will need to increase dues or restructure their budgets. From a buyer's perspective, if an association doesn't meet this requirement, buyers using conventional financing may not qualify for standard conventional financing for units in that building. And they may have to look into alternative portfolio products, which usually ends up costing more for the buyers, and that limitation to them directly affects a seller's ability to close a deal. Now, change number two revolves the reserve study baseline funding method is now being eliminated. Some associations have been using the baseline funding method, which is a budgeting approach where the reserve balance can approach zero as long as it doesn't hit zero. Fannie Mae is no longer permitting that. If a lender uses a reserve study to document that a project has sufficient funds, they can no longer use the baseline or threshold funding methods. The lender must verify that the association's budgets the highest recommended reserve allocation identified in the study. This takes effect August 3rd, 2026 for new loan applications. Now, change number three is that the limited review process is being eliminated. When a buyer finances a condo, the lender has to review the project, which means the building's financials, reserves, insurance, any pending litigation. There have historically been two paths for that review: a full review, which is a comprehensive review, and a limited review, which was a streamlined, faster track. To qualify for a limited review, buyers are required to put down a significant down payment, usually at least 20% on a primary residence, sometimes 10%, and 25% or more on a second home. The idea was that a larger down payment meant less risk, so a deep review of the building's finances was not required. But here's the catch. A larger down payment didn't automatically qualify the building. If a lender discovered issues during underwriting, such as a pending special assessment or management problems or deferred maintenance, they were required to switch to a full review anyways, and the building could still be denied. And Florida buyers already face stricter loan-to-value limits than the rest of the country under limited review. The limited review process is now being eliminated entirely, effective August 3rd, 2026, which is right around the corner. And according to a May 2026 legal analysis, almost 40% of all condo transactions were processed through the limited review. After August 3rd, every transaction will require either a full review or a qualifying waiver of project review. For sellers, the financial health of your association now carries more weight in the transaction than it ever has. Change number 4 is the new $50,000 per unit insurance deductible cap. Condo buildings carry a master property insurance policy covering the building and the common areas. Some of those policies include a per unit deductible, meaning a portion of any claim falls back on the individual unit owners. Fannie Mae is capping that allocated deductible at $50,000, and this has already taken effect back on July 1st of this year. There's also a new requirement tied to this. If the master policy has an allocated deductible, often called a per unit deductible, the unit owner must carry individual property insurance to cover that gap. So if you're purchasing a condo, it's worth asking about the master policy deductible structure before you get to closing. And number 5 is the small project review waiver has been expanded to 10 units. The waiver of project review previously applied to projects with 4 or fewer units. The threshold is expanding now to 10 units. So for buyers looking at smaller condo buildings, this can really simplify the financing process by allowing lenders to skip the full project review. And now let's talk about what's actually getting better. Because I want to be clear about something. Not everything in this update works against condo owners. There are a few changes in here that are genuinely good news, and they're worth knowing about. So let's talk about positive change number 1. Investor concentration limits are now being retired. Under the old rules, no more than 50% of units in a building could be owned by investors for the project to qualify under the full review. That restriction has been eliminated. This matters in Tampa Bay, particularly Pinellas County, where a number of buildings have higher investor concentration. Some of these buildings were previously non-warrantable for this reason alone. With this restriction gone, some of those buildings may now qualify for conventional financing for the very first time. That opens up the buyer pool, which is good news for sellers. Positive change number 2 is that insurance requirements become more flexible. Florida condo insurance has been a significant pain point across the entire market. Premiums have risen sharply, and some associations have struggled to find affordable coverage that meets the old requirements. 2 specific changes address that. First, roofs no longer have to be insured on a replacement cost basis. Actual cash value coverage is now acceptable for roofs. And let me explain what that means in plain terms. Replacement cost coverage means that if your roof is damaged, the insurance pays to replace it with a new one, regardless of how old the original roof was. Actual cash value coverage means the insurance pays what the roof is worth today, factoring in age and depreciation. So if your roof is 15 years old, you're getting a check for a 15-year-old roof, not a new one. From an insurance company standpoint, actual cash value policies are cheaper to offer, and that cost difference gets reflected in the premium. For condo associations in Florida, where roof replacement has been one of the biggest drivers of rising insurance premiums, this change has the potential to bring some real relief. It's not a solution to Florida's insurance challenges, but it removes a barrier that was making coverage harder and more expensive to obtain. Now, second, the inflation guard requirement for project developments has also been eliminated. And the documentation burden for verifying replacement cost value has been significantly simplified. The combined effect is that some associations may see some meaningful relief in their master policy premiums. Less money spent on insurance means more budget flexibility, which in turn can help offset some of the cost pressure from the higher reserve requirements. So let's talk about the bigger picture. These changes taken together are trying to do 2 things at once. 1, they're trying to make condo financing safer and more financially sound, which requires higher reserves and stricter reviews. and make condo financing more accessible by removing restrictions that were blocking otherwise healthy buildings from qualifying for conventional loans. It's not a perfect balance, and the short-term cost for some associations is real, but the direction is towards a healthier, more stable condo market, which ultimately benefits everyone who owns or wants to own a condo. I want to take a moment and talk directly to condo sellers and to any agent who may be listing a condo in this market. Selling a condo is not the same as selling a single family home. There is an entire layer of financial and structural review that affects whether a buyer can even get financing, and that review happens at the building level, not just the buyer level. One of the most important concepts to understand in this is your condo warrantable or non-warrantable. Warrantable condo meets the eligibility requirements set by Fannie and Freddie. It qualifies for conventional financing, which means lower down payments, competitive interest rates, and the widest pool of buyers. Currently, a non-warrantable condo does not meet those requirements. It may have issues such as reserve funds below the required threshold, pending litigation involving the HOA, more than 35% of the building is designated for commercial use, or there may be deferred maintenance or critical repairs that are flagged during the review process. When a building is non-warrantable, buyers cannot use standard conventional financing. They have to turn to portfolio lenders or specialty loan programs, which in turn typically requires larger down payments and can come with higher interest rates. That immediately shrinks your buyer pool and can put downward pressure on your price. So why does this matter before you list? I'm going to share a real scenario to illustrate why this matters. A buyer I was just working with went under contract on a condo. She had 15% down and was planning on conventional financing. The listing agent had not verified whether the building was warrantable before putting it on the market. Within hours of receiving the condo docs, budget, and financials, we discovered the building did not meet the standards for conventional financing. They did not have enough money in reserves. To proceed, my buyer would have needed to move to a non-warrantable loan, which meant a larger down payment and a higher rate. And she wasn't willing to do that, so she backed out of the transaction. The contract fell apart not because of anything wrong with the buyer or because of the price or because of inspections. It fell apart because the building's financials did not support conventional financing. Now, I want to be fair here. Requesting condo docs upfront is a standard practice, but in real world, you don't always get everything before you write a contract. That's a reality. What a listing agent can do, and what I encourage every condo seller to ask their agent about, is to take the time before listing to really understand the building's financial health. That means reviewing the HOA budget, confirming the reserve fund percentage, checking for pending litigation, and understanding any known financing issues within the association when that information is available. That information doesn't just protect your buyers from surprises, it protects you from going under contract, putting your plans on hold, and then watching a deal fall apart 2 weeks later over something that was knowable from the start. Selling a condo well means understanding what you're selling. The building is part of the product. So what does the condo market look like in Tampa Bay right now? Here's where the condo market stands across our 3 counties based on MLS data at time of recording, which was the end of June 2026. Hillsborough County has 965 active listings with 224,000 median sales price with 6.2 months of inventory. Pasco, 423 active listings, 149,000 median list price, and 9.1 months of inventory. Pasco, 2,233 active, 279,000 median sales price, and 5.52 months of inventory. All 3 counties are around or above 6 months of supply, and Pasco is over 9 months, which is firmly a buyer's market. Pinellas has the most active condo inventory with over 2,200 listings currently on the market. Layer in these financial changes, some tightening, some loosening, and the market is in a real period of transition. Buyers have more choices and more leverage than they've had in years, and the buildings that are financially healthy are really going to stand out in this market. So for you sellers, if your association is in good shape, that's actually going to be a competitive advantage right now. So you really need to lead with that. All right, so let's go through a quick summary. Changes that add requirements to the process. The reserve fund now goes from 10% to 15%, which is effective January 4th, 2027. baseline reserve funding method has been eliminated, or will be eliminated. That is effective August 3rd, 2026. The limited review process eliminated, again, effective August 3rd, 2026. The allocated per unit insurance deductible cap of $50,000 has already been put in process. That was effective July 1st, 2026. Changes that are going to expand access or reduce burden is that the investor concentration limit is retired effective immediately. Roof replacement cost requirement has also been eliminated effective immediately. Inflation guard requirement for associations eliminated, also effective immediately. Small project review waiver expanding from 4 units to 10 units, again, effective immediately. Many of these changes are already in motion. The most significant ones hit this summer and carry into early 2027. Whether you're a condo owner thinking about buying or selling, or a buyer evaluating which buildings will be easy to finance, or you're even an agent trying to understand what your clients need to know moving forward, these are practical near-term considerations. Thanks for taking the time to watch this video. I'm Tammy Bilder with eXp Realty, the Builder Group. And if you have questions, reach out. My contact information is in the comments below. I love helping buyers and sellers across the Tampa Bay area. And this is a lot to absorb. So make sure if you're in the market for a condo or you're selling a condo, you do your research. It's going to be important. Thanks again, and I'll see you on the next one.